Football, the game of inches, as we know it, right? We've all heard our whole lives the saying, football's a game of about inches. You know, when you're seeing that fourth down and you're fourth and inches and you decide to punt it instead of going for it at the 40-yard line because you don't want to turn the ball over and have the other team in great field position because you failed to convert on fourth down. Now, I was thinking about that saying, and so many times, and I can relate to this when it comes to trading, that whether it be if I'm trading in the rapid FOREX market, aka binary options, aka money in minutes, also known as binary options. Um, Here in economy, we call it RFX. RFX is abbreviated for rapid forex, and that's just a fast-paced forex, exactly what it sounds. Forex, we collect and go after pips, and could potentially be in the trade from anywhere from 10 minutes to 10 days to 10 weeks to 10 months, depending on the style of trading that you are um, involved with. The style of trading that I like personally, I'm more of a scalper slash intraday trader when I trade the forex, but my specialty becomes binary options trading. And when I think about the game of inches saying, and I can relate back to football, I realize that trading is also a game of inches. And how many times can you guys relate to being in a trade, having that trade stop you out by a pipette, 2 pips, 3 pips, 4 pips, and then go in your direction? Well, it's not a coincidental issue that this is happening. It's because we are not fully aware of the zones and we're not completely checking different time frames. We might have missed something on the 4 hour compared to the hour, and we might miss something so small, but at the end of the day, it could be the biggest issue we missed that causes us to lose or win a trade. And some examples like this would be um, potentially taking an entry. So for example, I'll do another live example here. Looking at Euro USD and looking at from here, we can clearly tell we're in a downtrend. Price pushes up, starts getting rejected, and then we start creating a further push to the downside. And when this push occurs, we create a imbalance within this range. Now we have a low come in, and we're potentially looking to take a sell when price pushes up to 010, so 98010. Now, if we enter the trade here, or if I should say price action could have pushed up just a little bit more, our entry would have activated and we would have cleared. But so many people take this entry, they don't wait, they're impatient. They don't take this entry, or they take this entry instead of waiting for the complete touch of the 50%, or if you're taking a trade from, our Telegram group chat, you entries at 012, or say the entries at 010, you enter at 002 or 005. What you're doing is you're setting yourself up for failure. And because, yes, this trade cleared, this example, actually, you would have won the trade if you got in early. You would have got lucky, right? You would have got lucky. However, patience is a virtue. Now we can see when price action really pushed up to our exact area of interest, it did exactly what we wanted it to do. It reacted from that area and dropped. So if we're selling here, we're winning. Now a lot of us make the mistake in taking an early trade or getting in too early, and that really hurts us, right? Just as bad as it hurts the team who goes for it on fourth down and misses it. Okay, so I need you guys to relate to the team that's going for it on fourth down and missing it as the same. You're achieving the same thing by entering a trade too early or too late. So patience is a virtue. Following your strategy, following the plan is going to be your best friend when it comes to trading. Follow the exact analysis is going to be your friend, right? Don't get caught up in over complicating it. Don't get caught up in trying to, take more entries. Oh, price is so close to this. I could take it now, and then when it comes back, I could take it again. It doesn't work like that, right? They only have one chance to get the first down on fourth and inches. You only have one chance to get the entry at your entry area for it to react and go your way. Now, another example of this could be, let's take a look at USDJPY real quick. Another example of this could be, say you were trading FOREX and let's see. Now, say you're trading FOREX and you can clearly see that price has been in an uptrend. Here you see that it's possibly starting to go in a downtrend, and you miss the fact that this area here should be the idea retest area for a potential buy. Or this area even here, actually. Based off the 4-hour time frame, we have a nice area here. Let's see. Game of inches, guys. This was your buy, but because you're following a strategy, you're being disciplined, price did not come within and reach within the 50% imbalance here, and you're hating yourself. You're hating life that you missed this entry. But in reality, did you miss the entry? No, you did not get your entry. Price did not come within the range that you predetermined that you are going to take a trade at this area. Completely missed it. Fell short just a little. But what we do notice is that price went up, and we were under the impression that it left us. But we still have our order in. So when price comes back to this area in the future and actually pushes into the 50% of this imbalance, our entry is activated here. Right. And we're gonna go 1, 2, 1, 3, whatever you want. I like to go 3 to 1, where I can risk 1% to potentially profit 3%, or I can risk 1/4% to potentially profit 3/4%. That's how I like to do it, and that's how I like to trade. So here we are. What we thought was a game of inches that we thought we missed our entry. We actually did not miss our entry. Our entry actually came back and activated because we patiently waited for the exact entry. And the outcome is going to be victory. The outcome is price is going to hit your take profit. Now, you could trail your stop loss here. Now, where would I be looking to have my stop loss in this instance? I would look for key areas where price has created maybe some unhealthy price movement that came back to be respected, like this area we noticed here. Let me delete this. Okay, so we noticed that this area could potentially be a very significant area in the future when price comes back to it like it did here, ladies and gentlemen. Game of inches, smacked it directly on and respected it. So obviously you're not going to have your stop loss here. No, you're going to have your stop loss below this wick action, price action down here. To cover if price does wick into this area, we're not going to get stopped out. But if you take your trade, if you put your stop loss right at this area, right where the area of potential interest is, then yeah, you're setting yourself up for failure. So you want to make sure that you set your stop loss below any price action where price has reacted before. We can see clearly that price has reacted here and pushed away. Now we have this area of interest here. Prices come back down, exactly tapped our 50% of the imbalance that we were anticipating where price would react from. And now, ladies and gentlemen, you are in a trade that you can just continue to trail at significant areas of interest. So once we respect this high and start respecting this area, well, now we're going to trail our stop loss to the next level. Now, where that may be. This area is respected. This area is respected. Let's see where our next area could potentially be. We have an order block here. We have an order block here. We didn't get the imbalance here, but this could be our newest low. So if this is going to be our newest low, we're going to want our stop loss to be slightly below that. Okay, we're not going to want it to be here, so price in the future come down and test out these price action candles, and then we get wicked out or stopped out. No, we want to make sure that our stop loss is far enough away from a potential price reaction to wick out. Okay, so now we wait for our next area of significant interest to be broken. We have structure here, right here. Structure breaks significantly. We know price eventually, if it breaks, it will come back and retest. But let's see some key areas where we will anticipate price could possibly move to in the future. So we're going to want to stay and trail our stop loss below it, so we can just keep moving up and up and up. Now we have a trade that we started down here, and we have secured ourselves a potential 278 pips with the ability to continue to potentially take advantage of this move. And as we see here, price has just continued to rally and rally and rally. So if you're in a trend, if you're in an uptrend, you want to stick to the analysis. You want to follow the trend, follow key areas. Don't second guess yourself. Find the low, find the area from the low where potential price could come back, and make sure you cover it. Because when you get into areas where you're like, okay, this is a breakout, like this area here is a breakout, and you're like, this should be my stop loss right here, right below this breakout. Well, you're not really considering where price action could really come. And we want to look at other areas within this zone where price could react from. And how do we know where it could react from? We just look at where price has reacted from before. It's reacted here, 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 retest, broke, retest, broke again, retest, now pushing up. So odds are this area has been retested before. It may be retested again in the future. Then so this would have been our trailing stop loss the second time from this entry. And you could just continue to take the trade up, right? Continue to follow the trend and and crush it. Really, you can. I mean, you if you were in this trade, now where's your stop loss being? So, we can see that we have equal lows right here. But look, this is what I'm saying. This is a key area of interest. So we're not going to have our stop loss right at the candles. We're going to have the stop loss below these wicks here where price is wicked back below and respected. So our stop loss, instead of being right here, and when price came back to test this area out, we would have got stopped out if our stop loss was here. But just a slight movement of covering these little wicks here is going to be the difference between a continuation profitable trade or getting stopped out. And nobody likes to get stopped out here and then witness a massive increase. And the way which is another 420 plus pips, and the way we avoid that is by recognizing key areas and putting our stop loss below those areas, not at the area. A lot of people, for example, will sell this market and they will put their sells in here and they'll put their stop loss in right here, super sniper entry, they call it, right? When price comes back up here in the future, we're going to take this trade. This is a resistance area. There's no way price can go any higher. But look what happens, ladies and gentlemen. Price does wick and reject higher. Now, when we look in the past, we don't really have any price action in the past that's happened because we're in a new area of interest. We are in a new area, an undisclosed area for USD/JPY. Price has never visited this area before. We're at new highs. So in order to get an idea of where price can go and where potential areas of interest are, we can use a Fibonacci sequence tool to help us determine where price is trying to go. Now, this is called trend-based fib extension. I'll show you guys how to place it. In an uptrend, you're going to go from the low to the high to the newest low. And now we have potential areas where price could possibly move to. Now, knowing that price could possibly move to this area, this would possibly be maybe a target area, or this area here. We know the 618 is a significant area off of the Fibonacci retracement, so we can anticipate this area here, once broken, could be a very key area. Now, again, trading, just like football, is simply the game of inches. We know sometimes we lose trades by a pipette and we just question ourselves why. And the answer is, well, because the entry was at 400 and you got in at 402. But if you would have waited for 400, you would have cleared when the entry cleared at 401. So it's up to us to make sure that we're entering the entries correctly and we're executing our trades right on the money every time. And if we don't, and we get stopped out or we lose a trade, it's going to be relatable to that same feeling that that team has when they go for it on fourth down and they miss it. So with that said, I hope you guys caught a little bit of value in this video. I appreciate you guys. Please do check out more YouTube videos to come. There's going to be so much educational content and information that's going to be dropped. And I truly hope that it helps you guys. And most importantly, I hope it helps you with your trading, your mindset, how to be more disciplined when it comes to trading, and understanding that, trading, like football, is truly a game of inches. And if you don't get it on first down, you're going to lose, right? And the more losses you take, the worse season you're going to have in football, and the worst account growth you're going to have. You're not going to have positive growth. You're going to have negative growth, and that's not going to be a good feeling. You're going to hate yourself and hate the decisions you've chosen. In reality, you can stop that from happening just by being disciplined, creating a plan, and following it to the T. Appreciate you guys. See you guys on the next one. This is Chris Germont signing off. Bye for now.